सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen though.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The IMF has come out with its July update to its World Economic Outlook, and it talks about a whole range of things. It talks about the world economy. It talks about India, where there is some amount of good news. It talks about China, where there's some not so good news. And it talks overall at the world economy and inflation and debt levels. There's a lot to cover, and so let's get on with it. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And we have with us Radhika Pandey, Associate Professor at NIPFP, who's analyzed the report and written an article on it and can tell us what it says. Thank you, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's start with the relatively good news, which is what does the IMF say about India and its growth prospects this year and next year?
Yeah, so this is the July update to the World Economic Outlook that came out in April.
Right.
So this is not the full report. This is just providing an update from what the IMF thought about the global economy as well as the Indian economy in April.
Right.
So what it is doing is it is showing its projections as compared to 2022, that is last year,
Right.
as well as what it thinks now as compared to April. So what it had done in April was that its projection for India was revised downwards to 5.9% for the current financial year, which
Right.
is 2023-24. But this time, that is from April to July, now it feels that it's time to revise upwards India's growth projections. So the growth projection for the current financial year has been revised upwards by 0.2%.
So 6.1.
So it's now 6.1% for the current financial year, and for the next financial year, it is 6.3%.
I see. So we'll accelerate our growth in next year.
Yes.
I see.
So it's a slowdown from 2022, where we had a 7.2% growth for the last financial year. But given all the economic uncertainty, inflation, monetary tightening, we are still posting a growth of more than 6%, and it's a upward revision from what IMF thought about the Indian economy in April, which was 5.9%. And the main reason it's advanced by the IMF is the strong growth numbers in Q4, the January to March quarter, which is imparting a strong growth momentum to the Indian economy, and also due to better investment prospects. So we saw that investment posted a healthy growth in the Jan to March quarter, and that is one reason why India's growth projection has been revised upwards for the current financial year. Yeah.
Right. So that Jan to March quarter actually gave a boost even to the 22-23 data, as we saw with the GDP numbers. So that must have been a very strong quarter.
Yeah, we
indeed.
saw it was 6.5% in that quarter, and there was an upside for the manufacturing sector. Investment did very well, and that is what has given a boost to the prospect for growth in the current financial year. Though if we see again as compared to the RBI's forecast, it is still lower, because RBI projects a 6.5% growth for the current financial year. But yes, the good news is that we have seen an upward revision for Indian economy growth.
And that the next year is expected to be even faster.
Even faster, yeah.
Right. So now coming to global growth, because that, of course, it weighs down our growth as well.
Correct.
So what does the IMF say about global growth? Is that accelerating, doing better?
Yeah. So again, from April to July, IMF has upped its global growth projection as well by 0.2%. So in April, IMF projected global growth for the current year to be 2.8%, and now it feels that the growth will be 3%.
Okay.
And there are various, the reasons for this moderate optimism is the resolution of the debt crisis that we saw in the US that was posing a drag on growth, resolution resolution of the banking crisis in the US and Switzerland, also moderation in headline inflation, though core inflation still remains high. But as compared to 2022, we have seen softening of inflation. So these are some of the reasons that have led to some optimism, though we are still not out of the woods as regards global growth is concerned. But as compared to April, conditions look better for global growth prospects as well.
Right.
Though there are a lot of regional variations which are very interesting to see both for the advanced economies as well as emerging economies. But yes, if we see global growth as a whole, we see that there has been an upward revision in projection.
Right. And now I'm very lucky because our wonderful viewers, subscribers have sent in such good questions, which actually ask several of the things that I wanted to ask you. So one of them has to do with China.
Yeah.
As I mentioned in the introduction, the news for China is not quite as good as they would have liked. So the question is, the IMF report also talked about the slower recovery of the Chinese economy, which might have an impact on the global economic prospects. So what exactly is happening in China?
So what is happening is that, China lifted its COVID restrictions,
Right.
and that resulted in a spurt in growth in the January to March quarter.
Right.
The quarter-on-quarter GDP growth for the March quarter was 2.8%, which was quite impressive. And that led to this optimism that China's growth will be now positive and it will fuel global growth as well.
Right.
But what we have seen after the March quarter is that growth has been faltering. And the June quarter, the April to June quarter, saw a slowdown from 2.2% to 0.8%.
Ouch.
So there was a steep slowdown in the quarter-on-quarter growth. That is, the growth in the June quarter was only 0.8% higher as compared to the January to March quarter.
Okay.
Now, there are various structural factors at play, and we've talked about them earlier also. One of the main things is the weakness in the real estate sector,
Right.
which still persists. It started in 2020 when the Chinese authorities tried to clamp down on the real estate developers because they had taken a lot of loans, and that was leading to concerns about overheating and fueling of asset price bubble.
Right.
So they were trying to put a curb on the bank lending by the Chinese real estate developers. So that resulted in an immediate rise in debt defaults because there was a lot of debt that they had taken that resulted in unfinished inventory of houses. So on the one side, for the real estate companies, it resulted in debt defaults. On the other hand, for the Chinese consumers, it fueled a kind of a discontent because they were not getting their houses on time, and they had paid their full amount of money for the houses. They had also borrowed from banks to pay for houses. So overall what it resulted was in a decline in consumer confidence, decline in demand, decline in housing prices. So now what we are seeing is a decline in consumption, decline in investment. So on the other hand, in other countries, we are seeing increase in inflation, whereas in China, we are seeing just the opposite.
Right.
And whereas all the other central banks have been increasing rates, in China, they have been cutting rates. So they cut rates in August 2022, and again in June 2023, the People's Bank of China again cut both their short-term and long-term rates to boost consumer demand, though it's not yet happening.
Right.
So that is the reason, and so that is one reason, the weakness in the real estate sector. The other reason is, of course, the decline in demand for exports due to the slowdown in advanced countries.
Right. So now we've talked about growth, and the IMF, of course, spent quite a bit on growth. But there are some other aspects like inflation and debt that it also spent some time on. And so what did it say? Let's start with inflation. So
Yeah. So on inflation, it is talking about the fact that inflation has come down, but still it is above the target, and it is giving a very stern warning that the central bank should avoid premature cutting of rates, because we are, it's if we look at one data point and we see that, inflation is over and we should start cutting rates, that should be avoided. That's the policy advice given by the IMF in its report, that the central banks should carefully study study the data and then decide on whether they want to raise rates or keep it on hold, but not cut rates immediately. So that is one very, strong message that is coming out of the report.
Right.
And they have also said that, many central banks, after pausing rates, they have again raised rates. And last night we saw the US Federal Reserve also raising rates after pausing in June. There was expectation that, US CPI has fallen to 3%. Fed will now be on a pause on rate hike, but it again raised rates by 25 basis points. So the message here is that inflation is still elevated, though it has softened from 2022. And more importantly, core inflation has been very sticky, and therefore central banks need to remain vigilant on inflation control. And at the same time, what we saw during the SVB crisis, the bank crisis, what we saw was that when there is a high interest rate environment, banks start incurring mark-to-market losses.
Yes.
So they have to. So central bank's job is very complicated here, because on the one hand they have to control inflation, but on the other hand they also have to ensure that there are adequate financial stability tools to avoid that kind of a situation. So that's the message on inflation.
Right, and debt also they had some concerns.
Yes, debt is also a concern, and therefore the policy priority is that, now that particularly commodity prices have started to decline.
Right.
Therefore, the kind of fiscal support that was given during the time of the Russia-Ukraine war at its peak, those should be reverted back, so that, and there should be more emphasis on fiscal consolidation, debt sustainability, because a lot of emerging economies are in a very high debt situation. Their debt levels have reached at alarming levels, and that need to be brought down.
Right.
And in this context, there's another UN report that came out last week, taking calculations from the World Economic Outlook, which have raised some very concerning facts about debt. That debt has risen fivefold from 2000 to 2023. $92 trillion is the outstanding debt, and out of this, 30% is only owed by developing countries, out of which 70% is owed by China, India, and Brazil.
Ouch.
So that is a problem. So the debt burden is quite high, and when the debt burden is high, developing countries have to, make this difficult choice between spending on interest rates or development. And therefore, even the G20 presidency currently India is having. So there also we are talking about, coming up with some framework for debt resolution and debt restructuring, the G20 common framework. Though it is a complex thing, because China is the largest creditor, and bringing China and other private creditors on board is a problem.
Yes.
But the policy priority which is emphasized by the IMF is effective resolution of debt.
Absolutely, because as you mentioned, if a country has to spend more and more on just paying interest,
right,
then it can't spend on key things like health, education, and development in general.
Yeah.
So it's a big problem. Now I'll get to the audience questions. One of them is what you mentioned about the US raising rates. So they ask, IMF has flagged inflation and the stalling Chinese economy as major risks. Could the collapse of the Black Sea grain deal and the Fed pushing interest rates to a 22-year high make a bad situation worse?
Yeah, so see, the US is raising rates because currently it feels that the US economy is still very resilient. Okay, so if we look at even the IMF July update, out of all the advanced economies, the US economy seems to be resilient. From 2022 to 23, the downward revision is very small as compared to EU and UK, where we will talk about Germany, which has stepped into recession.
Yes.
But US is still in a strong position. Its labor market is strong. There is no wage price spiral. The people are still spending. The labor market is doing strong. Therefore, the central bank also feels that the economy is in a position to withstand one more interest rate hike. It's not that the growth is faltering and therefore interest rate hike will act as counterproductive. So that is the reason why Fed has decided to raise rates again and placed more priority to inflation control rather than growth, because they feel that growth is still strong, labor market is strong, job market is strong, and therefore they have tried to raise rates to bring inflation back on the target. So that is the
Right, which shouldn't be really a surprising policy by them, because it's exactly what we did. When our inflation was high, the RBI went at it. It went with a 250 basis point rate hike, in cumulative terms, and it tried to bring inflation down. And it's only once inflation started easing did they even pause. They're still not saying that they're going to cut. So inflation is the priority across the world, as it should be. But you mentioned Germany, and one of our questions is on Germany. They say that what comes as a shock from the World Economic Outlook is Germany's negative growth projections for the full year of 2023. Why is Germany struggling the most during this energy crisis? Is it due to the phasing out of their nuclear plants?
So, the entire EU is suffering mainly, firstly, because of high inflation, because of high monetary tightening, which has clamped down on its demand. Particularly for Germany, the problem is that they are dependent a lot on the cheap supply of gas from Russia, which stopped at the time of COVID. That impacted their manufacturing sector activity.
Right.
So, manufacturing was impacted. Inflation is already high. Monetary tightening is taking place. So it's a situation where inflation is high and manufacturing sector is not doing well, which is leading to a further contraction in demand. So those were the factors that impacted Germany, and Germany is already into a recession. For what we understand as the textbook definition of recession,
Two successive
quarters of contraction in growth we have already seen in Germany. So that is why this we have seen that even IMF has, though for all other countries also from 2022 to 23 there's a downward revision, but from April to July, they have upped their projections moderately, except for Germany. So Germany is, as of now, in a weak position because of a number of factors. High inflation, ECB has been tightening aggressively, and that has resulted in a contraction in demand. Gas prices has been impacted because of supply from Russia. So all these factors have resulted in the current economic situation in Germany. Though going forward, there is some hope that now because of fall in prices, the German economy will also recover. But currently, that is the situation.
Okay, and now coming to India, there's a question, and even you had mentioned about how our Jan to March quarter saw solid investments happening. And the person asks also, saying that the government in parliament has also talked about how domestic investors took the lead, even when foreign investors were leaving the market when globally things were not looking good.
Correct.
So what they ask is, why do you think that there has been a change in the approach of domestic investors, that they're not being affected by the behavior of foreign investors anymore?
Yeah, so that's a very interesting feature of our market. What we have seen is that when FPI, the foreign portfolio investors, have been net sellers because they are more sensitive to what is happening in the US, how the interest rate decisions shape up in the US, what is the relative return of assets in US and in other emerging economies, and then they base their investment decision. So even in the months where foreign portfolio investments have been net sellers, we have seen the domestic institutional investors have been net buyers. So that is a kind of maturity we are seeing in Indian investors, that they have tried to invest long term and not bogged down by short term disturbances, which is now yielding fruits for them also. We are seeing the stock market has risen to heights, and so what happens happens is when FPIs turn net buyers for a sustained basis, then they start, taking out their money.
Right.
So that is what we have seen, a very interesting phenomena that when FPIs have been net sellers, the mutual funds and other institutional investors have strongly invested. They are the net buyers. But when we see FPIs turning net buyers on a sustained basis, then for some time we see MF started, withdrawing their money and making returns on their investments. So that is the situation we have seen. It shows confidence and maturity on the part of investors that they are not just looking at short-term ups and downs. They are investing in the market long-term and looking at the long-term growth fundamentals of the economy.
So that actually bodes very well for the Indian economy. If our investors are showing this kind of maturity, it shows that our economy as a whole is maturing as well.
So that is what we have seen over the last, at least in the post-COVID period. A lot of it is also to do with the fact that other investment options are not that attractive. And therefore people, and with the advent of digital payments, easing of this transactions, opening of account, demat accounts have become very simpler. So all these have led to cumulatively a greater interest in stock market and people staying invested for longer.
Right. And now we've talked about how a lot of developing countries are under very high debt stress, and how actually several of them, including several of our neighbors, have had to opt for an IMF bailout. So we have a question here, which is, how does the IMF bailout work? Who funds it? And how come countries repeatedly ask for IMF bailout and the IMF then approves it? And how does the repayment of these bailouts work?
So there is a structured process for this IMF bailout. There are various packages. So what happens is that initially the country approaches the IMF, places a request that it wants a loan, and there are various windows for loans. There are concessional loans, there are loans on market-based, there are loans for long-term. They have set up various trusts. One is the Sustainability and Resilience Trust. One is the Trust for Poverty Reduction. So there are various trusts through which money is given to the countries. But what is also equally important is that the countries have to meet certain conditionalities which are posed by the IMF, which are mainly to do with opening up of the economy, structural reforms, reducing trade barriers, making the exchange rate, moving on the fiscal consolidation path, making your exchange rate more market determined. So all those policy prescriptions which the IMF prescribe, those have to be adhered to by the country. Then only they will get loans. So sometimes what happens is that it's very difficult for a country to adhere to those prescriptions, because those very prescriptions would have led to higher debt burden. Because if their currency is fully market determined, there could be steep devaluation, which will further lead to debt default. So they might not want to adhere to the IMF's policy prescription, and that is when they go to other creditors like either China, or they go to private creditors. So that is what we are seeing, a shift in the composition of debt away from IMF and other multilateral institutions towards China, because it provides debt, but it provides that opaque rates of interest, and at that time they just need that money.
They're desperate.
They are desperate, and that is what is taken care of. That is the advantage that the Chinese also take, and that is why they get a lot of loans. And when it comes to debt restructuring and debt resolution, it creates a problem, because all the creditors are not on the same page regarding what is the haircut that they want to take and how the debt restructuring will happen. So a critical component of IMF package is the conditionalities that are imposed on the countries.
So there you go. What the IMF has said about global growth is that it's revised it upwards marginally, but there are regional variations. Countries like, say, Germany has not seen it. In fact, it's seeing a recession for the full year. At least that's what IMF is expecting. For India, the growth has been revised somewhat, but it's revised to 6.1% for this year. And next year, it's set to grow even faster. China is set to slow down. from next year compared to this year, and even this year compared to what they said in April.
Yeah, China is
Right.
said to grow. Yeah, 5.2%.
Right. And overall, inflation is coming down, but core inflation is still quite high and sticky. Inflation overall is still higher than target. So countries around the world are going to be targeting that. Debt levels in developing countries especially is a matter of concern, something that the IMF has flagged as a major concern. So there are various things that the IMF has said, various things that policymakers around the world are going to have to take note of. But on that note, that's all we have for you. Thank you so much for watching. But before you go, I have an appeal to make before you, which is please do subscribe to ThePrint. It allows us to do the groundbreaking ground reporting that we have been doing so far from places like Manipur and all over the country, from the south, from the northeast, from places like Gujarat, Jammu and Kashmir. We brought you stories from across the country, and we're allowed to do these kind of discussions as well. But apart from that, you get a lot of benefits from subscribing. Things like you get exclusive invites to our subscriber exclusive webinars, where we get experts to talk about the news of the day. You can write into us on the Your Turn section. We publish it as an article. And you get in your mailboxes, you get newsletters from all of our editors. They also talk about the news of the day. They break it down for you. So please do subscribe. The link is in the description of this video. And thank you so much for watching.